Thanks for the invitation. It's impressive that so many want to turn up and understand what's going on in Europe, in Italy better on a weekend. So I'm very, very happy to be here. And I just want to give a little bit of introduction, right? So I'm not a politician, I'm not a senator. My job is to essentially do forecasting, right? I have a forecasting company. I'm based in New York. What I do day in and day out is predict the future, right? We try to, in my company, advise governments, investment companies, so forth, what is ahead. So I'm just going to try to give a very objective assessment as to what I see. And I might have my own political opinions, but this is going to be more what I see ahead as opposed to any kind of political manifesto of sorts. So let's see if my slides work. If my slides are broken, I'm still not going to jump off the stage like Alberto did. So let's see how it goes. Okay, so far so good. The reason I'm here is that, you know, in the Euro crisis that Alberto talked about, I did some academic papers and I wrote this book about the problems in the Eurozone and the challenges that was faced by especially countries like Italy, right? And the old challenges are the ones that Alberto already spoke about. We had a lack of fiscal integration, right? When you have a common currency, it is necessary to have a form of fiscal transfer mechanism that we didn't have when the euro was created, right? You know about that because you've been reading Alberto's blog. We didn't have a backstop really for banks, so when banks were in trouble, things got very wobbly. I remember sitting on a trading floor in New York back in 2011, right, and look at all the banks going down 10% in like half an hour, right? It was not so fun to watch. That was because of the lack of infrastructure to support those. We had a deflationary bias, which makes it very hard to manage debt, as we've seen over the last 10 years, right? Up until recently, until the COVID shock, we had a strong deflationary bias. The dynamics in debt that Alberto spoke about is related to that deflationary bias as well. And then we had the politics, right? We started to get very wobbly politics with confidence in the euro lagging. So those were the challenges that we analyzed in detail. I wrote a paper about how to actually break up the euro at the time if we had to do that. And that's is in a way the reason I'm here today. But let's go through, right? Because the euro is still here. So let's just talk a little bit about what has transpired. And we've had some initiatives that we couldn't really anticipate 10 years ago, right? We had following the euro crisis, we had, you know, backstop for banks put in place. The ECB was willing to do things that it had not been willing to do before. Mario Draghi obviously was instrumental in reshaping what the ECB was allowed to do. And then we had COVID, and COVID put in motion certain things that previously was seen to be impossible. So we have this fund called Next Generation EU that has generated transfers that previously was seemed impossible, and Italy has gotten funds from that program. BTP spreads, very volatile. We can see the date Alberto spoke about back in the autumn of 2011. Very wide spreads. We have had, you know, investors regularly. I speak to investors all the time, and they regularly talk to me about Italian politics, right? So you can see in this chart, investors getting concerned about Italian politics on and off. The move in 2011, in 2021 and 2022, the latest move up in spreads in Italy, that actually had nothing to do with Italy. That was because global interest rates were rising, and there's a very strong statistical link between what spreads are and global interest rates. So that was really just a global move, and it also wasn't that big in the context of what we've seen before. So in a way, things look more stable on this front than they used to. Nevertheless, we've also had a change as a function of those shift where people have gotten more relaxed about the euro. So this is a euro and EU-wide chart, right? Support for the euro bottomed at around 50% in the EU level in the euro crisis, and has been going back up as things have looked more stable. Even in Italy, if you go and ask people on the street, how do they feel about the euro, the support has gone up over the last 10 years. Nevertheless, if we think about growth, these charts just break growth down into some major periods, right? There was a pre-global financial crisis period. There was the sort of a recovery period after the global financial crisis. Then we had that period with extreme deflation, and then we had the COVID period. All the periods are different. You can see Spain is very volatile and so forth. But the bottom line from these charts is that on the left, overall growth in Europe has been lagging the US by a significant amount. Some of that is demographics. On the right, I just strip out the demographics and look at essentially GDP growth clean for the labor force growth. And you can see the European countries have tended to lag the US by a significant margin, and it's across all these periods. It's not in one specific period, right? So we have issues that we need to think about hard, certainly when we look at the growth performance. And then, turning to the future, a lot of the things that I was very concerned about 10 years ago were issues that were very much internal to Europe. Like, it were things that were as a part of how Europe was set up by design by European institutions and so forth. But I think now we're looking at a situation where it is actually some external forces that are going to be much, much more important. We all know about the energy security issues that have become extremely serious after the full-scale invasion of Ukraine by Russia. We have an overall situation around military security that we've not really had to think about this way in Europe since, you can argue, the Second World War. So a totally new situation. We have an immigration situation that we can see is starting to really impact politics in a way that can dominate everything else. So from a political perspective, it's very important and cannot be ignored. And then I would say also, like, one thing I focus on a lot on a day-to-day basis is really thinking about global capital flows. And I can see there are some changes happening slowly that perhaps not everybody is aware of that suggest that the euro's status as a reserve currency is starting to be in question to some degree. So I'll just go through these 4 bits and add a little bit more detail to each one, and then I'll reach a conclusion. And we will continue more discussion with Wolfgang and the rest of the panel a little bit later. So the energy situation is one that obviously was extremely serious last year, where the monthly energy import bill of the Eurozone essentially doubled. So on a monthly basis, right, the import bill went from less than 30 billion euros to more than 50, almost 60, right? So an incredible shock that was an outside shock that Europe had to deal with and still is dealing with. A lot of the extra energy costs came from natural gas becoming more important, more expensive, and that is something that has been talked about a lot in the German context, right, but it's really impacted a large part of the Eurozone and the EU overall. And just this chart just shows kind of where we are on that, right? So we are not in the extreme crisis situation we were a year ago when prices went to literally 10 times normal. But nevertheless, even if prices have come down a substantial amount, you can see the current level of natural gas prices is still 50% above what was the max before to this war starting. So it's not as extreme as a year ago, but it's still a very, very serious issue that has serious costs that we have to take into account when we think about what are budget constraints and so forth in the current situation. When you look at economics, it's always a very tricky situation, right? Because the economy is so complicated. There are so many different forces at the same time that drive one variable, right? Here, I have a very simple chart of manufacturing production in Europe, and it looks like a number of countries have been doing okay, but it's hard to actually see what's going on because we also had an incredible amount of stimulus around the world that was put in place in 2020-21 that propped up consumption. But if you look at it this way, I think you can see very clearly that if you break the numbers down, the energy crisis in Europe is a very serious one. This is German industrial production. The vertical line is when Russia invaded Ukraine. And you can see that if you break down industrial production into the stuff that is energy intensive and the stuff that is less energy intensive, it spills out very clearly, right, that we've had this dramatic setback and this ongoing restructuring of the industrial sector that comes from the energy shock. So even in the headline numbers, it might be hard to see, but if you dig under the surface, you can see that this is a very, very serious issue, which makes logical sense. Then there is the military threat. So this is just a long-term picture of how much different European countries spend on their defense, right? So it is well known that the US is a country that allocates a big proportion of its GDP to defense spending. In Europe, we have over many decades been heading lower, right? So if you look at the low point on this chart, the period 2010 to 2019, we got to close to 1% of GDP military spending, which is a historically low number. And then we've been edging a little bit higher, and obviously this data ends in 21 before the war situation escalated. So we are heading towards a number that is closer to 2%, which some countries now have as their target. The problem is that we have a neighbor, Russia, that is willing to spend 10% of GDP. Russia's budget that was just announced entails 10% of GDP military spending, right? So even if the EU has a population that's 3 times larger than Russia, even if the EU has a size of its economy that's roughly 10 times the size of Russia, Russia is not a big economy. Nevertheless, the military spending, if we're only at 1% of GDP for the EU countries, which is where we came from, it would be the same military spending. And this is something that I think Europe has to think hard about what is necessary. We live in a totally different world. Unimaginable things have happened in the last couple of years, right, that just means we have to reassess realistically what is needed on this front. Obviously I'm not advocating wars, right, but the size of your military is very important to what deterrent you have and how other countries behave. And these are basic numbers I put on this slide that I think important to think about that issue. So the third issue I want to talk about, and I'm going quickly through these different topics here, is the migration issue, right? And in a way, this is related to Russia as well, because the big wave of immigration we had into Europe was linked to the Syrian issue, which also escalated when Russia got involved in Syria, right? So all these issues are connected. We had, I think the German line is probably the one that is easiest to look at, also because Germany is the largest country in the EU, right? So the actual numbers there are very big. You can see that green line, how immigration picked up as the situation in Syria escalated. The numbers here are how many is coming in per year per 1,000 people, right? So if it was 10, it would be 1% of the population that was added. So in Germany, we got close to 0.5% of the population was added at the peak of their inflow in 2015, 2016. I'm mentioning this because you can see when you look around Europe that these immigration issues are absolutely crucial for all political developments. We just had an election in Holland, the Netherlands, where the outcome was very much a function of what views on immigration are present. So this is going to be a driver of politics. Irrespective of what you think about immigration, you cannot deny that it's going to be a big driver of politics. And you can see that in that chart. This is not a chart that I could submit to an econometric journal and get approved for you know, doesn't have any vector autoregressions or anything. But this is just descriptive statistics, right? There are a lot of countries around the world where they use a kind of inflow of foreign labor as a way to grow their economies. The gray dots is the relationship between growth and immigration in a global set of countries like Singapore, Canada, and Australia that use inflows of foreign human capital as a way to grow their economies. But you can see in the Eurozone, we have not had a positive link between the inflow of immigration we've had and the growth. Clearly, it's been a different sort of immigration, so I don't think there's anything particularly surprising about that. But it's just something to keep in mind that the immigration we've had into Europe has not been a growth-supportive type of immigration. It's been obviously done for different reasons, but it's something that is just a factual observation that's worth keeping in mind. Then I'll turn to the final dimension of this Euro debate. So this is the kind of stuff I do on a day-to-day basis, right? I look at a lot of financial market variables. Here's some of them. The one to the left is from the website we have internally, right? So what is going on the left? The chart on the left is simply what is the Euro's share of all central bank reserves globally, right? So that would be the reserves of China, the reserves of Russia. They used to have euros in their portfolio, don't have it anymore. They've sold them all. Everybody pooled together. It used to be the case that the euro's share was around 25% of all reserves. Then we had the period where we had interest rates going into negative territory. People were starting to accumulate other currencies, such as Canadian dollar, Australian dollar, maybe some Chinese renminbi, and the share went down to 20. What's really interesting about that chart is that now interest rates are much higher, central bank interest rates around 4%, and what has happened to the line? Nothing at all. So the foreign investors that were reluctant to hold euros when interest rates went negative have not come back. So this is a potentially quite significant thing that now looks more structural than just a move as a function of interest itself. The chart on the right is one I've started to look at. The data is a bit volatile, so I don't think this is totally definitive, but the latest trends in terms of international bank transactions from SWIFT is showing a big change in terms of the use of the euro internationally, with, you can see the percentage of euro transactions going from well above 30 to now approaching 20. So that's another sign that the euro's role in international transactions is starting to go down as focus shift to using other currencies. Part of that is China, and we'll talk about that in a panel later in the day, wanting to use the Chinese currency in international trade. But I'm just giving you the statistical numbers there, and there's definitely a new trend to watch, which is not looking positive. And then there's a chart here, which again is the type of numbers I crunch day and night, and I think don't get quite enough attention. So I'll spend a little bit of time on what this is. This is looking at data for essentially aggregating all portfolio investments, all investment in Europe. What are they allocated to? Are they buying international investments or something inside Europe? This is looking at all the stuff outside Europe. And the blue line is equity, stocks, and the orange line is bonds. You can see for both, we've been in a trend now over the last 15 years where the share of non-European investment, both in bond space and equity space, has been drifting higher. So this is a quite interesting thing. It also shows that European investors are looking more to get exposure outside of Europe, and obviously by definition that means that their share inside Europe is declining. This is something that's very important to watch. If this does not start to reverse, especially for bonds, even when we have much higher interest rates, again, it's a sign that there's some kind of structural concern. So I think that's something to watch very carefully. And you can kind of see in terms of how the euro is trading, right? So euro dollar is above parity, but not much. And this is with the ECB having raised rates from negative to 4%. You would have thought, okay, we're going to be way above parity, but there's some other issues going on that is keeping the euro low. So with that, I will summarize. Actually, first thing I want to do this one, and then I'll do the summary. The way the euro has behaved in this period of inflation in the last 2-3 years has been quite different from how the euro or the euro's predecessor currencies, such as the Deutschmark, behaved before the euro was created in '99. So look carefully at this chart, right? The orange line is German inflation. If you look at the 80s and the 90s, you can see that German inflation, the orange line, was generally the lowest line, right? So if you just compare with the United States and Germany, you can see the blue line in the 80s was clearly above Germany's, right? So Germany had a strong currency then. It helped them always contain inflation a bit better, and that was an outcome that the public liked. If we look at just the last couple of years, that situation has now changed, right? The orange line, Germany, is now meaningfully above the United States line, even if the growth performance in Europe has been weaker than the growth performance in the US. So that's not a great combination, and that has something to do with how the euro is perceived and is not able to deliver the appreciation that the Deutschmark would have delivered in the past. So I think this is a sort of a big picture way of saying something about how currency dynamics have played out, and there are some confidence issues in play that is feeding into this. As with everything in economics, right, there are literally 100 variables you can say is going to have some influence on this. Brigitte will have more to say about the inflation dynamic. But I think what we can say with confidence is that the fact that the euro has been weak on a global basis has definitely, all else equal, make this picture worse and made the challenge with inflation bigger and more painful than would otherwise have been the case. And then we're getting to the conclusion, right? So since the euro crisis, which is about 10 years ago, we've had a situation where we've actually had some of the issues that created that crisis addressed to some degree. We've had more fiscal transfers. We've had more backstop for peripheral sovereigns, banks, through quantitative easing and so forth. And as a function of that, as a function of spreads being more contained, more stable, we've seen the public support for the euro generally bounce across the eurozone, including in Italy. But now we have a set of new external and potentially bigger challenges. We have an immigration challenge that has a very aggressive feedback loop into politics that's very important. We have this inflation challenge that is very big right now and has been exacerbated by a relatively weak currency. And then we have costs that's going to make our fiscal situation much harder to deal with, right? Because we have to pay for more expensive energy. We have to pay for investment in new energy infrastructure. And I don't think we have a choice to think about military spending in a different way, considering the threats we have externally. So given that, this path over the last 10 years that was in the direction of more fiscal integration, more support across borders, is going to be really in question again, because the budget constraints are going to become binding. And then at the same time, the immigration debate can really dominate and shift politics very quickly. So I think that means that after a period of 10 years where actually some of the risks around the Eurozone were declining, I think it's very clear that these things together means that the risks are rising for a repeat, a Euro crisis version number 2. I'm not saying tomorrow, I'm not saying next week or even next couple of months, but this is more of a multi-year path where I think these risks are going up again. Thank you very much.